Yeah, well, we've always looked at EM spreads for a number of years, and I've got a very simple theory. At 300 over, they always look a little technically expensive. At 500 over, they always look screamingly cheap.
Irrespective of the country?
Yeah, I'm just talking about the index in general.
Oh, right.
And then if you currently spreads to JP Morgan are around 406, 407 over, and that's kind of technically about a fair value level. So what we've been saying recently is looking at EM generally and saying that actually it's getting back to more fairer levels if you want to start buying again. Of course, 25% of the non-China index is Brazil, Argentina, South Africa and Turkey. And so 25% of the index has already been hit pretty hard. So we think there are opportunities building in EM, looking at babies that have been thrown out with the bathwater, in general slide that we've seen in EM. At the moment, the main way that we would look to play it would be through hard currency, so through the dollar index, where you perhaps can get around 7% average yield. And of course, even if we get some further weakness in the capital, the amount of carry now, the extra carry, you can protect you from some weakness. So I think what we're looking at doing is dipping our toe back in, effectively got our finger hovering over the buy button at the moment.
Do you think that you can still be long external debt, so the hard currency, dollar-denominated debt, even if the currency continues to depreciate? Can you do the two together so you're somewhat hedged?
You can do in some way. What you've got to be careful is destruction of capital in terms of losing, having a complete default. Of course, some of these assets will get recovery rates. If a country defaults, it will look to refinance its debt and push its debt out further, and there is a certain amount of recovery in them. So there is a way of entering EM at the moment, albeit, as I say, you're moving in front of a very fast-moving locomotive. And so I think it's with caution, dipping a toe back in, but and not just piling in. If the spreads continue to blow out to 500 over, then that's a really good indication people should be buying for the longer term.
Can I just bring it back and ask about what has been happening in the US yield curve specifically? And it's a question I ask anyone, any fixed income experts, and whether or not you believe the yield curve still is reliable in terms of offering signaling. So we've seen this massive yield curve flattening take place, and some people have said that may or may not portend at the beginning of the next recession. The economy seems far from it at this point, growing at north of 4%. So perhaps the yield curve really isn't sending us proper messages anymore.
Well, I don't know about that. The flat curve, in 1994 to 1995, the US curve was extremely flat, and it was one hell of a bull market in risk assets. You know, we could have a flat curve now for the next 2 or 3 years, and risk assets can continue to perform. I think what it does indicate is that if there are macro imbalances or anything that occurs, that the curve could easily turn negative at some point, and that might be a signal at that point. But we could have a flat curve for a number of years, and that doesn't necessarily mean that we're signaling a recession.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.